Hello everyone and welcome back to the channel. So a couple of quick notes before we get into today's video. The first one being that we're taking a slight break here from our stock market terms videos, but those are going to be continuing after this video. If you haven't seen the first three in the series, I'll link them in the upper right corner of the video now. Secondly, while this video today is going to be specifically for Canadian investors, the channel as a whole is not dedicated only to Canadian investors. It's for the stock market in general, just so you're aware of that. Okay, so today's video is going to be about TFSAs or tax-free savings accounts and RRSPs or registered retirement savings plans. So let's get right into that. Okay, so let's start off the video by talking about why TFSAs and RRSPs are important for your investments. And the reason for that is these are tax-free accounts, and what that means is that you're not going to pay tax on any interest or capital gains that you earn in those accounts. So if you're using a non-registered account, just a regular account to invest, you're going to have to pay capital gains tax on those earnings. And that amount is obviously going to depend on your tax bracket, and I'll put on the screen right now a screenshot of the tax brackets that you can expect if you're living in British Columbia. I'll give you a link on in the description down below if you're living in a different province, so you can look that up. But the point is that it's going to be quite high, 15% or higher in most cases. So you're going to lose a lot of your money if you're not using an RRSP or a TFSA account to invest. And that brings us to our second point here, and that is a lot of people, when they have RRSPs or TFSAs, don't realize that they actually have control of that money and they can invest themselves using it. They'll often bring it to a bank and a financial advisor, and they'll say they want to set up a TFSA or an RRSP account, and then they'll just have the financial advisor invest that money for them. But this is your money. You can do what you want with it. You can invest it yourself. And most banks out there do have self-directed investment account options available to you. If your bank doesn't have that, you can often just go to a brokerage service such as Fidelity or Questrade and invest through them. So I'm going to put up a list on the screen now of all the different banks that I've just come up with in a short period of time here to show you how many of them are available to you. So here's a list I put together of banks that I found that offer self-directed investment account services. So starting in the upper left corner there we have CIBC, and their service is called Investor's Edge, followed by Bank of Montreal, and their service is called Investor Line. Then we have HSBC, their service is called Invest Direct. RBC or Royal Bank is called Direct Investing. Scotiabank, or the Bank of Nova Scotia, is called iTrade. Toronto Dominion or TD Bank is called Direct Investing. And then below that I've just included a couple of regular brokerage services that are quite well known, Questrade and Fidelity. So if your bank is not on this list, it doesn't mean that your bank doesn't offer it. This is just an example list that I've put out for you. But if you don't have a TFSA or RRSP, it doesn't have to be with your own personal bank. You can set it up with any bank, and also you can move your TFSA or RRSP account to any of these services from where they are currently. So what I mean by a self-directed investment account is you're actually the one doing the buying and selling. There is no middleman involved. So you're going to be buying the stock, bond, option, mutual fund, whatever the case may be, directly, and paying a commission to the service to do so. Each service is going to have its own commission fees or transaction fees. So whatever bank or service you're interested in using, make sure you check that to see how much the per trade fee is going to be. And also each service is going to offer a variety of different services. So if you're interested in a particular service, make sure that you check to make sure that that bank is going to offer what you're looking for. Okay, so now that we understand that TFSA and RRSP accounts offer distinct advantages in terms of taxes, and also that self-directed investment accounts are widely available and easy to set up, let's talk about the advantages of TFSAs over RRSPs and vice versa. So let's start with TFSAs. I think the biggest advantage that a TFSA has over an RRSP is that your money is available to be withdrawn whenever you want. So you can basically deposit the money in there, invest it, earn interest or capital gains on it, and then just take it out as if it was a regular savings account. So let's talk about the disadvantages of a TFSA account as compared to an RRSP account. The first disadvantage is that you're limited to a maximum of $63,500 total contribution into a TFSA account. For a lot of people that's not going to matter, but if you have more than $63,500 to invest, you're not going to be able to put all of that into your TFSA account. The second one, and this is one that a lot of people don't realize, is that if you have American stocks in your TFSA account and these stocks pay dividends, 15% tax is going to be withheld by the American government on those dividend payments, even though it's in your TFSA account. This is part of the American trade agreement with Canada. So there are a lot of people out there in Canada that have US equities in their accounts. So just keep in mind that if those stocks pay dividends and they're in your TFSA, you will be paying a 15% tax on that. So let's flip the script and talk about the advantages of an RRSP account over a TFSA account. So the first advantage is that dividends that are paid from American stocks that are held within an RRSP account are not subject to tax like they are in a TFSA account. So if you have the choice of holding American dividend paying stocks in either type of account, you're better off using an RRSP account for that reason. So the second advantage of an RRSP account is that the contribution room is usually higher than that of a TFSA. It's calculated based on 18% of your income and is carried forward if you don't use the maximum contribution for that year. The third advantage of an RRSP account is that contributions that are made to your RRSP can be claimed as a tax deduction when you file your taxes at the end of the year. So since your employer pays income tax directly to the government, when you make this tax deduction, it usually ends up in a large refund at the end of the year, depending on how much you've contributed in your tax bracket, of course. And this money can be used to be reinvested or for whatever you want. As far as disadvantages for an RRSP account, I can only really think of one, but it is a pretty major one. And that is the fact that when you deposit money into an RRSP account, you can't just withdraw it whenever you want to. There are some exceptions to withdrawing it, such as for a new home purchase, but in general, the money that you put into that RRSP account, you should be leaving in there until your retirement. So that about covers it for today's video, everyone. Hopefully I've conveyed to you the importance of using TFSA and RRSP accounts for your investing. If you did learn something, please consider giving this video a thumbs up down below. It really helps the channel grow. And if you have comments, concerns, or criticism, please leave it in the comments section down below. Thanks, and I'll see you in the next video.